Bismillahirrahmanirrahim. So today we'll finish chapter 7 of Davis and Holt. It's still on asymmetric information, but it's about asset markets now. So asset markets are, like stocks and other assets which pay off some dividends and also have changes in price. So there are many kinds of uncertainties in this market, and actually the main kind of uncertainty is one which is not discussed in the text, and unfortunately economists don't understand this type of uncertainty. This is the type of uncertainty which Keynes and Knight introduced in the 1920s or 30s. And basically uncertainty means you don't know what's going to happen. You don't know what states are going to be. You don't know what their probabilities are. Now, due to a fallacious argument that became widely accepted and continues to be accepted today, people thought that uncertainty could be reduced to risk. Risk is a situation where you know all the possible states and you know all the probabilities of each state. So they said that, okay, objectively you cannot know, but subjectively you can. And there's a argument there which actually in another paper I have shown that argument is wrong. But unfortunately this is not known or accepted widely. So state uncertainty is something which we do not consider. Actually that makes a big difference, because how you act under uncertainty is different from how you act under risk. But anyway, we consider the situation of risk here. So risk is where there are different types of possible outcomes. So you have a stock, it may pay 10% with probability 50%, and it may pay 20% with probability 30%, and so on. So you have a distribution of possible returns. These are often called states of nature. So there is one state in which the stock is worth $20, another state in which it is worth $30, another state in which it is worth $40, and maybe they all have 1/3 probability. So this is how uncertainty is characterized. So this is one type of uncertainty, which is about the state of nature. Another type of uncertainty is that different traders can have different values for the same asset. So these are private values. Now this is a bit strange in the case of stock, because stock is fixed, it's just a monetary value. So the way that the text justifies this is to say that there may be different types of taxes which people are paying, which are depending on their other incomes. So for that reason the value of the stock can be different to different traders. Also it can have to do with ownership of the company and control and things like that. So it's possible that different assets have different values. So this is, again, you don't know, and so you don't know how much the other person values this stock. So that is an important piece of information in terms of how much you can sell it for. Then there is also behavioral uncertainty, which means that how do other traders behave in this situation. So often the economists assume that they have rational expectations and they optimize, but both of these are bad assumptions. So the question of given that they don't know my private value, they don't know what's going to happen in the future, how do they form ideas about this? So this is a whole unexplored question. And then the question is, given certain kinds of expectation, how do they behave? And the third question, which is not considered but most important, is how do they learn? And given that something didn't happen according to plan, what do they do in the next period? Actually, you see, what economic theorists are currently trying to do in game theory is to get the game to converge to a Nash equilibrium. Now this is ridiculous. From the beginning you have decided that this model is true, and now you run regressions until you find something that fits your model. So this is exactly what's happening. You already decided that it's going to be Nash equilibrium. Now you keep changing the experiment until you find something which converges to your Nash equilibrium. That's not a way to do science. Instead, what we need to do is to find a theory which will explain how the game is played in every round, not in the last round when convergence happens. So if you can find some theory which explains how people behave when they don't know anything and how they learn, and then you can explain how the convergence occurs, then you have a theory. Currently nobody is even looking for such a theory, so we have a problem. So the economists have massively wrong models about how expectations are formed and how people behave, in the sense that they typically assume rational expectations and then they assume optimizing behavior under these expectations. Both of these assumptions are wrong. So the correct type of models will have heuristic decision making, where you make a decision you just make what's called heuristic is rule of thumb. You don't know anything, so you say, okay, this is what it's worth to me, I will ask for 10%. So this is without knowing anything about what anybody wants and what the demand is and what the supply is. You just make some decision based on very crude rules, and then depending on whether that does okay or not, you change that decision. So this is the correct types. They have heuristics with low information and bounded rationality. You can't do all the calculations that's required for optimization. You don't know all the information that's required for optimization. So anyway, we will this is the type of theory that will emerge later after you guys start doing your research, but for the moment we'll study what's currently available in the book, and that's rational expectations. So what is rational expectations? Well, rational expectation basically is like this, that and the theory of rational expectation is like all other theories, that instantly we jump to equilibrium. So what happens out of equilibrium, how you reach equilibrium, these questions which are most important are put out of the picture. So basically, you see, now if I want to sell an asset, I have to know something about how it will perform tomorrow. If I think that that asset is going to double in value tomorrow, then I will ask for a very high price for it, otherwise I'll keep it. If I think the asset is going down tomorrow, then I will sell it cheaply. So what the future is like is very important in asset markets, and so what do I know about the future? This is the expectation. So now the theory of rational expectation says that suppose we look at all the expectations of everybody, and typically they should be the same because they are rational. So these expectations are about the future. Now, given these expectations, then once you have these expectations, then you can determine how the people will act, and everybody will act to do some maximization. So suppose that we assume everybody has some expectation, then we calculate their optimal behavior, and then some market outcome will result. So now if this result is in accordance with the expectations, then this is called rational expectation. So the outcome, you're thinking about what the outcome will be, that is your expectation, that determines how you behave, and how you behave determines the outcome, and the outcome determines the expectation. So there is a loop, and if this loop is consistent, then you call it rational expectation. Of course, so basically rational expectations are those which will not be disappointed by what happens. You will not be surprised to see what happens, because that's what the meaning of rationality is. So one major problem that occurs in this situation is that there are always multiple rational expectations. So for example, especially in monetary models, if everybody believes that the economy is going to go down tomorrow, and so all the stocks are worthless, then in fact everybody trades like that, and this actually becomes a self-fulfilling prophecy. So self-fulfilling prophecies are very common. So you can create expectations in which everybody thinks that all the banks are going to flop and they flop, or you can create another expectation in exactly the same model where everybody thinks that the banks are going to do very well and then they do very well, and you can create another model in which they all think that it's going to do moderately and they do moderately. So you have a multiplicity of rational expectations equilibria. So then what happens? Nobody knows. I mean, this is a problem which, because economists don't study how you get to equilibrium, then you can't answer this question. So basically what matters is how expectations are formed and changed in disequilibrium, because initially at least, I mean, learning is taking place. People don't necessarily always have the right expectations, and if they are surprised, then what do they learn from this? Now, according to economics, they are never surprised. So one of the implications of rational expectations is that there will be no bubbles in the stock market, because bubbles happen when everybody thinks that the price is rising. But if there's a crash coming, then somebody is going to get surprised. So the reality is that the bubbles occur in experiments easily and also in real world, which means that rational expectations is basically refuted. However, Lucas refuses to believe this. I mean, even after the global financial crisis, he said that I have another explanation for this, and it doesn't violate rational expectations. So basically the point is that, you see, rational expectation is a hypothesis about what's going on inside the heads of people. So because of that, you can construct stories which will create a match to reality. This is always the case, that the unobservables, you can never get a perfect fit for. You can never get 100% certainty about what these things are, and you can always twist them around to match observations. So if you make them complicated enough, you will get a match. So another implication of rational expectations is that if some people in the market have insider information, they know what's going to happen, but others don't, then this information will somehow percolate, and everybody will acquire this information. So this basically reflects, basically economists are engaging in magical thinking. Somehow magically the world automatically reaches efficiency and equilibrium, and how it gets there we don't know and we don't care, because it's automatically getting there. So this is the question which we are now going to study. You see, insider information could also be that people benefit from it, others do not. So will insider information be revealed or not? This is the question that we will study. There's a very famous joke about this, that since everybody automatically learns everything, so the two economists were walking past and they saw $100 bill, so on the footpath, on the sidewalk. So one of them says, don't pick it up, because if it was real, somebody would have already picked it up. So this is one experiment about with we had many types of uncertainty. This is type uncertainty. So there are three types of traders. Each type has 3 people. So this is an experiment with 9 people. So they are given an initial portfolio which has cash of 10,000 francs and 2 units, that is 2 units of stock. Now all of them have the same assets. Now these are different, the stocks are the same, identical in all of the traders. So there are 3 times 2, 6 stocks in each type, but they can sell with each other, and the value of the stock will not be determined by the label of the stock, but by the type of the trader. So the one who holds it, that is the one, that will be the value. So if you have dividend value, the type 1 has 300 in period A, and then in the second period he has 50 value, and in the similarly in the first period type 2 trader has value 50 and 300, and in this the type 3 has 150 and 250. So what will happen in the first period? Well, in the first period what should happen is that since the value of the type 1 is highest, so he should buy the asset from the others in order to realize the best profit. So basically there are these 6 and 6, 12 units for sale by type 2 and type 3. Their own value is only 50 and 150, so they should sell to type 1 for around 300. Yani, this is the famous, yani, some price between 150 and 300. And since there is excess supply, well, it's not excess supply because they can all buy everything. This is the important thing, that the money that they have been given in cash is enough to buy everything. So they can buy 3 times 2, 6 units from type 2 and 6 units from type 3. So that there is in fact excess demand, so prices should converge to 300, because the traders will hold on to their assets and sell to the highest bidder. And in the type 1 there are 6 traders and they all want this asset. It's worth 300 to them, so they will be willing to bid against each other and bid the price up to something like 300. So then, but in the period 2, this asset is only worth 50 to them. So but what they will do in the second period is they will have all the assets in the market, and they will sell this for 300 to type 2 traders in the market. So they will buy this for 300 and they will make virtually zero profits, but in the next period they will make profits by selling this for 300. So that's the so-called naive outcome, in the one in which no information, yani private information, remains private. But now there is another equilibrium which will occur if this private information becomes public, and that is that they are buying for 300, but they are going to be able to sell for 300 in the next period. So basically the value of this thing is actually 600, because it's 300 in the first period and 300. So if this was the information, then the equilibrium value should be 600. So then the experiment was run, and so according to, there are 2 types of equilibrium. One is the naive equilibrium, according to which the period A price is 400. I don't know why he gets 400. I thought it was 300. There must be a mistake. Either the top number here is 400 or the bottom number here is 300. So in period A, so the naive equilibrium, and one in which private information remains private, the first period price should be 300, which is the max, and then the second period price should be 300, which is also the max. But if there is a perfect foresight in equilibrium, everybody knows everything, then first period price should be 600, because that's the value of the asset, and the second period price should be 300. So there's some, and the allocation in the period A, type 3 traders will hold all 18 units. Why? Why will type 3 hold all 18 units? Well, I think that if that bottom value 150 is changed to 400, then we can make sense of this. Because then the type 3 trader will have value 400, and then they will buy all of the assets, and in the next period they will sell to 2. But then the 600 doesn't make any sense anymore, because I see. I see. So I see. Right. So basically, nobody knows anything for the second period. So, but yani for the others, you know your own value. So for the type 3 traders, the value of the asset is 400, 150 plus 250. And for the type 1, it's 350, and for type 2 is 350. So basically, in the naive equilibrium, the type 3 will buy up all the units for 400, and then they will get 400, and there will be no sales in the second period. In the second period, because they are only earning 250, so they will be able to sell. Instead of realizing their own 250, they can sell it for 300. So this is what will happen in the naive equilibrium, that the type 3 will buy everything for 400 because they can make 400, and they know that they can make 400. Other people don't know what the values of the others are. And then in the second period, they, instead of cashing in their 250, they will sell everything to the type 2 trader, and they will realize 300 instead of 250, which they could get on their own. So now this makes sense. So the value of the asset is 400 in first period and 300 in the next period. Now with perfect foresight, what will happen is that the type 1 trader will buy everything in the first period for 600 because it's worth 300 to them in the first period, and they know that they will be able to sell it for 300 in the next period. So this requires the dissemination of information. So what actually happens when you run this market? So in the first period, you get year 1. In period A, the price is clustering around 400, and in the period 2, it's rather underneath 300. So that's the naive equilibrium, and that's natural because nobody knows anything. But in period 2, you get more stronger clustering around 400, and again the second period is not quite 300 but getting there. But now in the third period, you have what is called swim back. Now the people have observed what the price in period B is, and they can use that in their first period calculations in year 3. So now you see that the value of the asset is rising above 400 in year 3 and in year 4 and 5 and 6. Meanwhile, the second period, the B price is getting now settled at 300, while the A period price keeps rising until it gets close to the what is the perfect foresight equilibrium. So we start out at the naive equilibrium, and then people learn the perfect foresight equilibrium, so that the information does get revealed when you have multiple plays. So this is a very important. Why do we have multiple plays? In the real world, we don't get to play the same game twice. It's like this computer game. You get killed and then you get another life. So that's not real life. If you get killed in real life, if you are racing, that's it. You don't get a second life. So this is like the computer games. So what do we conclude from this? If we have repetition, and this is with identical values, then this allows players to learn the future, because actually the future is now the past. They have seen this future. So now to argue from this that this kind of thing will work in the real world stock market is just stupid, because stock market is continuously changing every day, and there is no experience that is being built up, because we don't have the same configuration repeated, so that now you learned what happened last time, now use that experience to do the same thing again. It's like the second life in the computer game. So the question is, does this experiment help us in understanding the real world? It's hard to say. I mean, what we are trying to argue is, will inside information be revealed? Well, yes, if you repeat it many times, then it's no longer inside information, because everybody gets to see it. So this doesn't tell us what will happen in one-shot games. Now, what people do understand this, they said, can we speed up this convergence? So they created a futures market, and that does help in speeding up the convergence. But does that mean that we should create, a futures market? Because actually, this is what economists argue, that if you have a futures market, that will help you get to efficiency. Well, that's only if you repeat multiple times. In the real world one shot, it may actually cause even more damage. So the question is, are prices formed under information, or are people gambling? So if they are gambling, which is actually, there's lots of evidence that a lot of gambling takes place in the stock market, where people are betting on what will happen in the next minute, which doesn't depend on anything which happens in the real world. It depends on how other people are behaving. In that case, none of this analysis is really irrelevant, because the information is generated on the fly. So anyway, economists are very reluctant to consider this type of question, because it goes against their paradigm that markets generate efficiency. But in fact, if there's a lot of gambling, then markets can generate inefficiency. And actually, Islamic rules would prohibit gambling and would allow ownership of shares. And there are many ways to do that, if unfortunately Muslims are just bent on copying stock markets. But actually, what is called day trading would not be allowed in an Islamic market, in the sense that you are allowed to buy stocks for ownership in a company, and then you can make profits from the business of the company. You cannot make profits by random fluctuations in the sales, which is what day trading is about. That's not permissible. Your profit should come from a legitimate, real source. So if somebody manipulates the market and doubles the stock prices and you get rich, this is not permissible, because there's no real activity which is the counterpart, where you got the money from. So here is another market which is of similar type, and we want to know whether the insider information will be revealed or not. So there are two states of nature. One is state X, but the other setup is pretty similar, type 1, type 2 and type 3, for each type of trader. They all have cash of 10,000, and then they have 2 units of assets. Now, but what happens is, there's no longer 2 periods, there's only 1 period, but a coin is tossed, and if it comes up heads, then state X occurs. If it comes up tails, then state Y occurs. In state X, the values are 400, 300 and 125, and in state Y, the values are 100, 150 and 175. Oh, and the state probabilities are not 50-50, it's 40% value probability for state X and 60% for state Y. So if you just calculate the expected values, 0.4 times 400 plus 0.6 times 100, you get 220, 210 and 155. So this is the average value of the asset. So if the traders are risk neutral, then the value of the asset will be 220 to type 1, which is the highest. So basically, what should happen in period 1 is that everybody should sell to type 1 for around 220. That's what would happen if there is no information. So now insider information was provided in this market by passing out cards. half of the cards were blank. There are 12. Yeah, there are 12 traders, 4, 4, and 4. So 6 of the cards have marking either X or Y, which reveals the true state, and the other 6 are blank. So the state was revealed to 2 traders of every type. So there are for every type there are 2 insiders who have the inside information, who know what the state is going to be, and 2 outsiders who do not have this information. So now we have a market in which there are some insiders who know the information, some who don't. So what would happen? Well, let's look at the private information. That's the easy. Suppose that information does not leak. Then what will happen is that in the state X, if you look at type 1, that's the highest value, 400. So state type 1 insiders will know exactly what the value of the asset is, and it is 400. So they will want to buy the asset for 400 from type 2 and type 3, who know that regardless of what the value is, it's not going to be 400. So the type 1 will buy up all of the assets from type 2 and type 3. As far as and also the other assets from the outsiders, because the outsiders don't know the state, so for them the value is 220. So they have so they will buy up the assets from everybody. So if state X, type 1 will end up holding all the assets. If it's state Y, then type 3 has 175, which is the highest value, and they will end up holding all the assets. In private information, type 1 insiders will end up holding all the assets, because type 2 outsiders will not know which state it is, so they will also sell everything to the insiders. And in state Y, the outsiders have the value 220, which is higher than 175, which is known the Y state. So now they will actually make the mistake, and assuming that, you see, private information, nobody knows about the information of others, so to them the value of the asset is 220, but the type 1 insiders know that the value is only 100, and so they will sell. For type 2, the value is 210 on the type 2. Yeah, type 2 value is 150 for the insiders, so they will also sell. Type 2 outsiders have value 210, they will also sell. And type 3, the insiders know that the value is 175, they will also sell. And the outsiders have the value 155, they will also sell. So everybody has incentive to sell to the type 1 outsider who doesn't know the value and thinks that it is 220. So that's the private information. With full information, in case X, type 1 will own all the units because they have value of 400, and in state Y, type 3 will own everything at 175. So now what happens when you run trading in this market? So in the first period, no information was provided, and the prices were close to the equilibrium prediction of 220. There's no private information. This was just the baseline case. In the second case, we had private information given to 6 insiders, So now you see that in the Y state, the convergence should be the average price was 189. It should be to 175 in the Y state, which is the highest, but it was still private information, so the 220 has some pull. In the X state, the value is 400, and you see that the prices are rapidly rising towards that. And in the subsequent period, you have in period 3 you had Y was the state, in period 4 X was the state, and so the price rose to 400. In period 5 Y was the state, and the price was now 163, close to the equilibrium with the full information, revealed information. In period 6 again it was Y, and again the price was 173 average. In period 7 it was X, and after a initial steep rise from the 220 equilibrium zero information, it rose quickly to the full information price of 400, showing that the information was revealed by the sequence of trade. In period 8 you have near convergence to your 175. In period 9 state X, and now you have convergence to the full information equilibrium. And in period 10 again you have convergence to fill information. And in the final period, that was sort of a test, private information was provided to everyone, and then you get to full information equilibrium, which is exactly. So basically, again, this shows that you get convergence to full information equilibrium. The information is revealed by trading, which is sort of the supposed to be the magic of the markets, that the prices reveal all information. But the experiments are being done in such a way that forces this outcome. So the idea that markets disseminate information doesn't really get proven by this methodology. So this is the theory that markets disseminate information. There is also a theory that markets aggregate information. All prices are put together efficiently, and all the pieces of it, different people have different types of information, and these are collected by the market and aggregated to arrive at an efficient outcome. So something like this happened in the previous experiment, and this is another experiment like that, in which we have 3 states with 3 different probabilities, and in this one the players were given different types of information. You see, full information in the previous experiment, the full information was revealed. This is the state. Now, some of the traders were told that the state is not X, but it could be Y and Z, and some people were given the signal that it is not Y, so it could be X and Z. So different types of information was available to different agents, but nobody knew the exact state. So now the question was, will the market be able to aggregate this information and come up with the equilibrium in which the information is known to everybody? So this was the experiment. Well, basically there were no clear results from this. The initial experiment showed that there was a failure to aggregate, but as people learned and they experienced with this, they made a simpler design, and they found a situation in which the market could aggregate the information, but with different types of experiments and with slight changes in conditions, you could get many different outcomes. So basically this was a test of the Hayek hypothesis that markets aggregate information. So basically the summary of this whole asset market picture is that, first of all, we are giving it the best shot. We are doing things to try to make the economic theory work, and it's not clear whether, how much relaxation we have given. We are maximizing the simplicity. Real world markets are very complicated, and the experiments show that if you make a very simple experiment, it can converge to the theoretical outcome if you give it enough tries. But if you make slight complications, then many different things can result. So as I've discussed, the real goal of the experimentation is something which people are not even looking for. They are looking for experiments which confirm theories. What they should be looking for is how people behave under genuine uncertainty. And actually there's a lot of literature available on that. This is called heuristics literature, and basically how people behave when they don't have any clue as to what's going on. So there's a lot of literature. It's not being used in the mainstream right now, but that's where the action is. And also how people learn. This is a very important subject. Okay, so here's another experiment which was done to okay, I'll skip that because it's not very important.